Hello YouTubers, welcome back to the Independent Investor weekend update for November 11th. I was just talking about oil demand and just saying the Paris-based International Energy Agency had demand per day increasing 1.6 million barrels per day for this year and then 1.4 for next year. And I can't remember, but I think it's about 90, can't remember the exact number of barrels per day total production, but demand. And that growth rates of 1.4, 1.7 and 1.4. Yeah, so I think it's around 90 to 90 million barrels per day or so average demand. And that's above the That's actually above the long-term average growth rate of 1%. So, kind of contrary to intuitively what you'd think about oil, right? As we get bombarded in the papers with electric vehicles and more advertisements and people talking about that. So, the underlying demand is still there. Of course, there will be a transition, but these transitions typically take a fair amount of time. So, so I think these two could be interesting plays. Again, I've defined them as turnaround plays, and the big thing is the oil price underneath. And if that turns over and goes down again, then I simply sell these out. And maybe I was wrong, or I mean, nobody can really forecast oil prices that well in the short term, and it's as long as you define what you're doing. So on Noble we see we've got $21 in book value on a company that's trading at when this report was put out 3.89. We're up to 4.63 now, and its revenue per share was 4.9, so like a 1-to-1, which is quite low. A little bit concerning is the amount of debt. The debt is 3 times revenues. It has been higher, and they have brought it down a little bit. But again, we expect these because these are turnaround plays. And Noble might take a little bit longer to turn around because it's more offshore contract drilling rigs, and right now there's more growth, like I say, in the fracking, and that's on land rigs. So this might take a little bit longer to turn around, but so Noble also, they have scrapped, and that's with some of these losses and write-offs over the years, a lot of their older rigs. So they do have one of the youngest fleets of rigs. That means they're more efficient, and should be able to make a better profit margin if prices continue to turn around. So again, this mentions consolidation. There's been mergers between ESCO and Atwood. Transocean purchased, Transocean's another big player, North Sea based drilling operator. So again, we're seeing that, which is typical when a sector, an industry really has a major slowdown for a long period of time. You see companies go out of business. You see the ones that are left start purchasing either the ones going bankrupt or some of the smaller players at a discount, and we're seeing that definitely take place. So that was that. The other one, so Nabors, NBR, again we've got $10 in book value, it's got $11 in revenue, while 7 projected for 2018, but this year it's going to be about 10, and it's trading around 640. So again, price to sales ratio extremely low, trading comfortably below book value. Again, this has a lot of debt. Almost $4 billion for revenues that are 2.5. But we can see how badly this has been affected. We had revenues of almost $7 billion. We dropped last year down to 2.2 billion. So it has been quite a difficult time with oil prices staying so suppressed. But again, Nabors have been doing lots of acquisitions, so again, they might come out of this in a pretty strong situation. They've also just purchased robotic drilling systems, which provides automated tubular and handling equipment, and again, is going to help increase the efficiency of their operations. And Nabors might come back a little bit quicker because it has the largest land drilling rig fleet in the U.S. and stands to benefit strongly when oil prices regain some of their former vigor. The company experienced a 50% sequential jump in the number of American rigs in operation during the second quarter, but the day rates on the rigs have not really came up yet, so their profit margin is still quite low, and probably going to continue to lose money for a bit. So this even next year, Value Line has them losing about 10 cents. But if we see that turnaround, people will get onto these because there's investors that look for silico plays, and these type of investors have patience, and they'll buy now and wait it out maybe for 1 or 2 years, right? And that's what I'll probably do as long as oil prices really. I'm not going to sell these off if oil prices just drop $5 again. I'll give them time to work, and but if a year from now or 6 months from now oil's back in the 40s, then I'd probably just get rid of these. So I'll just and I'll monitor the technicals. Say both of these have been showing a nice bottoming and possible turnaround. On Noble, I like these pitchforks here. We bottom right down here at 320, and now we're up to about 4.6. It's kind of got that trend going up. The McDye's increased. We're staying above the zero line now. The money flow indicator has turned up, and so these could be quite interesting plays. And NVR is the same. I like this 3 fan. It's broken through 1, 2 now, but I usually wait for the 3rd. So it's a little bit uncertain now. We're seeing more buying volume than selling volume, but it's still a little bit questionable right now if that's going to completely turn around there. So that's it on those two. And I've been talking about for some time now, one of the major themes on this market and all the companies borrowing money because interest rates are low because of the Fed action, the quantitative easing, and buying back shares. And I was pretty astonished going through reports when I came across, of all companies, was McDonald's Corp. We all know McDonald's. We think of it as the kind of blue chip of blue chips and very slow, low growth. And even that, I wonder if they can maintain their growth. They have redesigned a lot of their restaurants and McCafe and improved their coffee, but there's been a shift in diet habit, how people eat, and towards healthier, I think. And we've seen a lot of different restaurant chains come out with different themes trying to capture that. But what I found quite astonishing is their book value has gone negative. It's like 2.69 book value per share. Again, I said one way you can see if a company is almost bankrupt, if you take their assets minus their liabilities, and that's negative, and then you divide that by the shares outstanding, that gives you a book value per share. And then we have this blue chip of blue chip companies that had forever slowly growing book value. Back in 2007 to 13, doubled over 13 years or so, which you would expect in a company like this. And it's also increased its dividend quite a bit. So it's almost like it's harvesting it's kind of its book value. And this, I haven't seen this kind of thing before. We're seeing lots of things in this market that are making people's heads shake. And can it be sustained? Will it revert back to the old normal kind of reversion to the mean, back to the old metrics? And we can see here, like, clearly the revenues are 22 billion, growing very slow, and actually they really haven't grown over the last 10 years. But we can see the share price is almost up 300% with a company that's not growing its revenues. And revenues actually are a better predictor on the long period than earnings, because earnings can be manipulating, earnings cycle a lot. So it's actually revenue growth over the long term that is a better predictor of how a company stock price will perform. And so again, it's this clear debt buildup. We've got now $28 billion in debt, which is more debt than their annual revenues. And that has actually doubled over just the last 10 years. And of course we see that showing up in the shares dropping from down to 102 million down to 775 for this year. So they've bought back almost, getting close to a quarter of their shares at elevated prices. I have nothing wrong with a company buying back shares if they can't do anything with that money, because then you don't want them investing in something that's not going to be profitable. If they can't find anything, then they can buy back their shares. But only if their shares are trading close to book value or low. Otherwise, to me, they're kind of wasting that